Hello and welcome to an FX Times daily video recap. I'm CMS Forex market analyst Nick Nassad. Today is Friday, December 18, 2009. In a look at the euro-dollar pair for this week, we see that the dollar has been soaring on evidence that real signs of a recovering U.S. economy are now working in favor of the greenback. Also, we're seeing concerns over the debt burdens of Greece and other Eurozone member nations weighing on the euro. That, along with the massive run-up in risky assets this year, funded largely with cheap US dollars, has prompted some investors to take dollar-negative bets off the table ahead of the year. Today we saw the euro continue its slide that we saw in yesterday's session following the second downgrade in the last 10 days of Greece's credit rating. This time it was the Standard & Poor's downgrading Greece's credit rating after its proposed plans for cutting its fiscal problems were seen to be too weak in order to fix the problem. The euro-dollar pair hit a 3-month low today at the 1.4260 area. Near zero interest rate policies in the US prompted investors to use cheap dollars to fund purchases in higher yielding currencies and other riskier assets throughout the year. It seems now that they are now unwinding these positions, boosting the dollar as the Federal Reserve in its FOMC meeting this week had a more optimistic view on the US economy. Though they did say that they expect to keep interest rates at a low level for an extended period of time, traders are already pricing in a faster than expected tightening policy. Looking at the pound-dollar pair, coming into this week we had been trading sideways in a bit of a range between 1.6350 and 1.62, and we had been forming this bit of a consolidation pattern. But on Wednesday's trading, we saw a breakout to the upside, hitting 1.64, though that seemed to become a false breakout and more of a pump fake than anything, and we fell back into our range and ran up against our support level in Thursday's trading, and that coincided with a very weak UK retail sales release, and so that pressured the pound, putting us down to the 1.61 level in Thursday's trading. Overnight, on Friday, we had the pair rebound to test this level, which had been acting as support, but now seems to have turned into resistance, along with the 50 period moving average. Here we're looking at the 1 hour time frame, and we fell back down as we had some broad greenback strength in today's trading. Following a test of the 1.6050 area in mid-New York trading, the pound did manage to pair some of its initial losses. Overall, though, we did have a break of this very important around this 1.62 area, and even this low here from last week around 1.6160, and it'll be important to see if we now have a further down move if we retest this area here. The greenback has been gaining against the yen this week and extended those gains in today's trading, hitting a 6-week high at the 90.90 level. Overnight, the yen fell against the euro and the dollar after the Bank of Japan said that it won't tolerate consumer price declines, which spurred speculation that the central bank will maintain the target lending rate at almost zero. Bank of Japan Governor Shirakawa and his colleagues refrained from announcing any more policy actions, choosing instead to watch the effect of a 10 trillion yen or 111 billion lending program adopted 2 weeks ago after the government urged them to do something about deflation. We see that today's high came just above the level we saw on December 4th. The yen will continue to be on the back foot as the US dollar seems to no longer be the preferred currency for funding carry trade, and if the yen resumes that mantle, it will continue to fall if we see risk appetite or growing signs that the overall global recovery is on pace. This week also saw the Swiss franc advance very sharply against the euro. We hit a low of 1.49 in today's trading, which is very significant as we saw a move below the 1.50 area. Previously, that area had caused the Swiss National Bank to intervene in the currency markets as it didn't want the Swiss franc to appreciate past the 1.50 level. Today the franc strengthened on reduced demand for higher yielding assets, and also we saw some geopolitical risk in that Iranian forces occupied an Iraqi oil well, which caused the safe haven demand currency like the Swiss franc to gain. Swiss policymakers did change their language on currency purchases at last week's quarterly monetary policy assessment, saying that the bank will act to counter any excessive moves by the franc against the euro. In its previous statement in September, the bank said that it would continue to act decisively to prevent any appreciation. So now traders will be looking to see what point along the euro-CHF pair is deemed to be an excessive move by the franc. Regardless, the last 3 sessions have seen a very sharp decline, and we'll see if we have a counter move to this very sharp fall to start next week's trading. Next week will be a shortened week as Forex markets will be closed on Friday for the Christmas Day holiday, but still we'll have a good amount of releases before then. From the US, on Tuesday we will get existing home sales along with the final version of third quarter GDP. Wednesday we get data on personal spending and incomes along with the UMich consumer sentiment, final version for December, along with the new home sales. On Thursday we get a measure of durable goods. Around the world, Monday we will get Canadian retail sales. Tuesday we get the UK current account and New Zealand's GDP figures for the third quarter. On Wednesday we get the Bank of England meeting minutes along with a Canadian GDP. And Thursday we get data from Japan including consumer prices and unemployment rate. And that will wrap up our coverage of the Forex market for this week. For more news, videos, and analysis, please visit our site fxtimes.com. I want to thank you for watching, and I wish everybody a very happy